All right, welcome back to another episode of Asset Coach and Tax Strategist. So, in today's episode, we're going to continue this conversation of passive income. I did an episode a few weeks ago talking about passive income and kind of using Robert Kiyosaki's explanation of saying, well, passive income isn't passive. Initially, it's very, very active. And so, what we want to do is go through what does that mean for you and I? But also, as we start looking at it from our business partner's perspective, the IRS, what's this also mean? So, for example, most passive income is taxable. Plain and simple. The IRS taxes most passive income just like regular income. Now, examples, rental income. So you purchase a piece of property, whether it's short term or long term, it's going to be taxable income. Dividends that you get from a business or stocks or capital gains, those are both going to be taxable. An online business is going to be taxable. Royalties you receive from oil and gas or some other type of royalty agreement, taxable. Okay. Now, why people think that passive income's tax-free? Some investors actually legally reduce or defer taxes using smart strategies. Now, think about it from this perspective. The IRS, let me take it one step further. The government is a business, period, plain and simple. And for every business, you need revenue. So think of your household is a business. In order for your business household to function, you need cash flow to go into that business household to be able to distribute that cash flow to satisfy your needs and wants. Meaning your income comes in, you pay for your expenses, and then you have discretionary income or profit cash flow at the end, and then you determine where does that go. And then usually as high income earners, where we're going to put that money, we want to put it into passive income type strategies, right? Where we have assets that are generating cash flow. But there's also tax benefits from this. The government knows this. So what they do is they dangle this carrot and say, hey, you can get tax benefits over here if you put your capital here. And I, your business partner, the IRS, is going to give you tax benefits when you put your capital there. So it's this relationship. The IRS, the government needs your capital in play so they can generate cash flow, revenue, taxes to them. Okay, so it's a win-win and you get the tax benefit. So, for example, real estate depreciation. Yes, you can take depreciation on your real estate. In fact, you can do a cost segregation study and accelerate that depreciation. And the one big beautiful bill allows us to 100% bonus depreciate. So you can take this whole depreciation in a shorter period of time. What that does is it creates it as an expense. When you actually look at Schedule E, page 1, under the expense column, it says depreciation expense. It's the only expense in the expense column that tells you it's an expense again. The government is laying out this breadcrumb, so to speak, this clue, like a video game, like I've talked about before. The tax code's a video game, and so you're going to find clues. This is a clue. They're telling you, hey, this is an expense, and we're giving it to you. Okay, so you put your capital here. Why? Because they need you to fund the housing need. Okay, so but here's the thing. If you take the full bonus depreciation in, let's say, that first year, and you sell that property in 5 years, well, the government's not going to say, hey, hang on, time out. As partners, I gave you this tax benefit, and now you're selling this asset that's not going to create future revenue and income. So what I'm going to need to do is I'm going to have you recapture some of that depreciation and offset that tax benefit. And now all of a sudden you have more capital gains, right? Which is taxes if there's a gain on that sale. Okay. Retirement accounts, same thing. You get a deduction when you put the money in there. So the government's saying, hey, we don't want to take care of you. Social Security wasn't designed to take care of you as a retirement plan. Companies got away with pensions. The reason why they did that, the government looked at this and said, hey, if we can make companies more profitable, that allows people to put their money in the stock market. So let's have people put money in their own 401k. Let's offer the stock market as options. And that creates liquidity in the system. And then we, the government or the elite, have the ability to have this liquidity and access to capital, and you get a deduction. And you also get the opportunity for this retirement account to grow tax deferred. Keyword deferred until you start taking the money out after 59 and a half. And in some 401k and traditional IRA and other similar retirement accounts, you have to take money out if you don't take money out. It's called required minimum distributions, and the current law rules is age 73. Roth IRAs, you don't have to do that. Now, here's the interesting thing. You put your money in there, you put it into retirement prison, right? It's meaning that your capital is sitting in there in prison, so to speak. You can go online and visit it. Hey, money, how you doing? How you performing? But it doesn't get released until after 59 and a half. Okay. And if you don't take out enough, the required minimum distribution forces releasement. Okay. Probably released on good behavior, right? We continue with that whole prison theme. All right, long-term capital gains rates. Well, there's short-term capital gains, which within 12 months, you're going to end up paying taxes as ordinary income, but it's over 12 months, it's long-term. It's either 15 or 20%, depending on your particular situation. Now, deductions and tax credits are also typically deductions or deferments for taxes into the future, and borrowing against assets. That's tax-free. So deductions and tax credits are essentially tax-free. Borrowing against assets is also tax-free. So what's that mean, borrowing against assets? So let's say you have real estate. Let's use your primary house as an example. And you have equity sitting in this house that's earning 0% rate of return, your equity. You're paying down your loan and your house appreciating. That gap is called equity. It's not earning any type of return. So you say, hey, let's go ahead and take out some money. Let's say 200,000. Let's take out 200,000. Now it is a loan. So you're going to be required to pay that 200,000 back to the bank. Okay. And so you take this 200,000 out and you go to put it into another asset. Well, that 200,000 that you took out is a loan, borrowing against the asset. The bank uses the real estate as collateral. That's not a taxable event. That's tax-free. So the wealthy call it the buy-borrow strategy, meaning buy assets, then borrow off the equity and the appreciation to buy other assets. Okay. Now, some income can be tax advantaged. So what do I mean by that? I mean, not always tax-free, but may have special tax benefits, so to speak. So for example, municipal bonds. Not a big fan of municipal bonds. I'm just going to tell you, it's maybe for a certain level of investor, but I'm not comfortable investing in or lending my money to a municipality and them paying increasing tax revenue to its constituents to pay me back a tax-free interest. Okay, that's my personal opinion, but that's what's happening. You as an investor are lending money to a municipality, a city or government, and they're going to pay you interest on that loan, but it's tax-free. And because it's tax-free, it's not a higher interest rate, it's a lower interest rate because you're not paying taxes on that. Okay, so they offset it versus when you lend somebody money on a promissory note, you get 8%, but that 8% is going to be taxable. You're going to have to 1099 on that versus a municipality. Let's say it's 6%, but it's going to be tax-free. Okay, so you got to look at your particular situation. If this is something that's of interest to you, and you can go make your decisions there. This is not financial advice, right? This is just education. Now, Roth IRAs can grow tax-free. You put after-tax dollars into a Roth IRA, assuming you qualify. There's some limitations, so you have to look at that. But let's say you qualify, you put money into a Roth IRA, it's after-tax dollars, it grows tax-deferred, and then it's released from retirement prison, tax-free. Okay, so there's no required minimum distribution. You still have to wait till 59 and a half, but after 59 and a half, you can take as much out or you can leave all of it in there if you want to. There's no required minimum distribution because the government already got their taxes on the front end. Real estate strategies such as tax deferred 1031 exchanges, opportunity zones. These are a couple examples that where you can have a piece of property that is appreciated. You're thinking about selling it, but you're like, whoa, that's a huge capital gain. I don't know if I want to pay those taxes. Well, you can sell it and then you can roll all of that over using a 1031 exchange into another like or bigger, better property tax free. So very, very interesting. Now, the IRS expects to be paid. This is a partnership. Both parties have to benefit from this relationship, right? So the IRS still expects to be paid. And so you must report all income, taxable or tax-free. Deductions, reduced taxes, yes, but they don't eliminate them. Okay, so you have to, if you have any one of these specifically structured in an LLC or some sort of business or Schedule C, you really need to have a good bookkeeping and accounting to track every single dollar. Okay, you need to have the compliance in the background because that's the business partnership. You are telling the IRS, your business partner, hey, thanks for these tax benefits. Here's how I'm reporting and documenting this. Okay. Now, hiding income can lead to audits, penalties, and interest. Now, what's that mean? Hiding income? I don't know. I don't hide income, so I can't give you an example of that. But there are some people who decide to do that, and it's really the perception of the IRS. So if you don't do a good job of tracking and compliance your money and documenting your money, and the only thing your business partner can say is, well, you show that you have more, your lifestyle looks like more. I kind of feel like you're hiding something from me. So let's get together and let's talk about it. And that's called an examination, or commonly known as an audit. Okay. Now, how does passive income, how does it get taxed? Well, rental income gets taxed as ordinary income on either your Schedule C, depending on your how you're structured it, or on your Schedule E page 1. Okay, this is all in your 1040. Dividends, there are qualified lower rates or non-qualified ordinary rates. Those are going to be on your Schedule B. Okay, Schedule B. Now, capital gains, whether it's long-term or short-term, are going to be on your Schedule D. Okay, business income, self-employment tax may apply. Now, business income, depending on how it's structured, could be on the Schedule C. Not a big fan, but it could be on your Schedule C or your Schedule E, page 1, which is specifically for real estate, or Schedule E, page 2, which is pass-through businesses, partnerships, S-corps, that sort of stuff. Okay, your royalties are also going to be tracked on your Schedule E. Okay, and this is going to be taxed as ordinary income, your Schedule E, page 1. Now, what smart investors do, this is important. They use the tax advantage accounts. They keep accurate records. Let me repeat that. They keep accurate records. They plan year round, not at the end of the year. They plan year round. They work with a CPA or a tax professional like our firm, but there's a process to do this as well. So you got to follow IRS rules and deadlines. You got to comply with your business partner. It's a partnership. They rely on your capital and they'll give you tax benefits, like I've said before. Okay, so taxable is most passive income is taxable. It's how you structure your entities, how you utilize the things that we talked about, and some other strategies that we have not talked about. Tax advantage are special rules and strategies that allow you to pay less or defer to later on. Now, you can defer later on to estate planning, which is an entirely different legal system and different tax area that you can actually defer into future generations possibly. Now, not tax-free, you still must report everything to the IRS, period. Report it to your business partner. Do not hide. Do not give them the thinking or the inkling or the thought or the curiosity that you're trying to hide something. Just be honest. You follow the rules. There's so many benefits. Just follow the rules and you'll be completely fine. So I thought this would be helpful, kind of breaking all this down a little bit. If you like this content, give us a thumbs up. Hit the subscribe button. We drop episodes every Thursday. If you have comments, add those comments down below as well. Thank you so much for participating and investing your time with us. Go make it a great day.